Most people are afraid of investing because of the number of tough decisions that they need to make. So, should you invest in small cap funds? Should you buy gold today? Should you be booking profits on your stock portfolio and putting it into FDs? These kind of questions can be very tough to answer, and you can make the wrong calls if you do not have a framework or a process for making them. That process is called asset allocation. Hi, I am Aarati Krishnan. In this episode of Question of Money, I will be talking all about asset allocation. So, what is asset allocation? It is the decision on how you will divide your entire portfolio into different asset classes. What asset classes? Equities, debt, real estate, gold and so on. So, suppose you have 100 rupees to invest, will you put it 50-50 in equities and bonds? Will you put it at 50-30-10 in gold and little bit in cash? So, these kind of decisions are what come within the asset allocation framework. The most important purpose of asset allocation is to control risk and more importantly prevent you from making hasty decisions driven by greed or fear. This can be the main enemy of wealth creation. So, why is asset allocation necessary? Now think, if you have a 1 lakh portfolio fully invested in stocks and there is a 25% market crash say in 6 months, you will lose say 2.5 lakh of that money at one go. That can make you very nervous and give you some sleepless nights. Now, if you had asset allocation and put only 50% of that 1 lakh in stocks and another 50% in say FDs, you would lose only 1.25 lakh to that market crash. That may help you weather that phase more evenly and without actually panicking or selling. Actually, when the market crashes, that is the time to buy more stocks and not to get out of them. So, asset allocation, by helping you divide your wealth between different assets that behave in various manners, helps you actually contain losses and also manage risk in a good way. To illustrate the importance of asset allocation, we took the most bumpy period for the Indian stock market from 1999 to 2009. This had two crashes. We worked out how an investor would have fared with a 50-50 asset allocation between the Sensex and FDs. Now, if you look at this calculation in this table, you will see that because of the asset allocated portfolio, at the end of this terrible period, the person was able to make nearly 11% annual return. This calculation does not assume any rebalancing, but rebalancing is a very important concept in asset allocation. So, basically if one asset goes far beyond the percentage that you had allocated for it, you basically sell that asset and go back into the other one which has become underweight in your portfolio. By doing this constantly, what you will be doing is selling high and buying low. This is very hard to do on your own because your emotions will actually work against practicing this. So, how do you decide on the asset allocation that is good for you? Should you be 50-50 or 60-40 in stocks and bonds? There is no one ideal asset allocation that suits everybody. It is actually a personal decision. So, you should take the following factors into account when setting this percentage. The first is your age. The younger you are, the longer you can actually wait out big falls in stocks or other risky assets to recoup your money. Therefore, if you are younger, you can have a higher allocation to risky assets like equities and a lower one to safe ones like FDs or debt. The second factor is your liabilities. Suppose you are already having a lot of loans and servicing EMIs, your risk appetite will be lower. You cannot afford to lose a large amount of your capital to market swings. In that case, you will have to have a lower allocation to risky assets like equities and more to safer assets. A third thing is your holding period. So, depending on your financial goals, you may be able to hold your portfolio for say 3 years, 5 years, 10 years depending on when the goal will come up. For goals that are less than 3 years, you should not go near stocks at all. So, that portfolio needs to be fully in debt. For goals which are 3 to 5 years, again it is better to stick to safer instruments such as debt mutual funds. For long-term goals like retirement, where you have more than 7 years, you can also afford to have a fully equity portfolio with a small allocation to debt instruments. A fourth factor you should consider is the number of your dependents. Suppose you have a family to support who may come up with emergencies and you need to withdraw your money at any time. Equities are unsuitable for that kind of situation. So, a person with a lot of dependents is in a fairly tight financial situation. They need to have a lower allocation to equities and a higher allocation to the safe investments. There is no need to complicate it too much. If you find it difficult, you can just go for a 60-40 portfolio, which is equities 60% and debt 40%, or a 50-50 portfolio, which is half and half. Whatever you do, start with a particular asset allocation and improve it as you go along.